Hey guys, I'm going to discuss the valuations of business developed companies and five metrics that I look at that I had Gemini help me configure real briefly, and then show you one of the particular BDCs and how its valuation metrics look according to each of these five things. So the first one I'll be discussing net asset value per share. That's a book value of the BDC. It represents the total value of the BDC's investment portfolio minus its liabilities divided by the number of shares. The reason why it matters is a rising net asset value per share over time is the number one sign of a healthy BDC. So if it's trading at a premium, for example, to its net asset value, that's not always a bad thing. You're definitely not getting a discount on the share price because it's trading above its net asset value, but that's a show of strength for the company. Basically, that's how you got to look at a lot of companies, a lot of BDCs that trade at a higher premium than their higher price than what their net asset value is. Basically, number two, net investment income payout ratio. Since BDCs are required by law to pay out 90% of their taxable income to avoid corporate taxes, you know the dividend is safe. And there's a formula you could use here that mentions why this matters. A ratio under 100% means a BDC is earning more than it pays out. So it's got a cushion. If it's over 100%, they are paying you back your own capital and dipping into reserves, which is a major red flag for a future dividend cut. The third metric, non-accrual rate. In the lending world, a non-accrual rate is a loan where the borrower has stopped making interest payments. Why this matters. This is the ultimate truth metric. It tells you exactly what percentage of the BDC's portfolio is failing. Healthy target for most top-tier BDCs aim to keep non-accrual rates below 1% to 2% max of the total portfolio at cost. Anything above 5% suggests serious underwriting problems. Basically, that's like probably in the case of charge off loans or companies that they loan to that didn't pay them back. So 1 to 2% is considered healthy. Anything above 5%, they definitely have issues because they're not being paid back on above 5% of their loans. That's how you look at it. Is their portfolio paying them back? Are the people they loan money out paying them back? And BDCs basically loan money out to middle market companies or a variety of levels of companies, and sometimes they take on secured debt too, or they take a lien on part of the company too, like whereas they own a percentage of the company potentially. All right, number four, weighted average portfolio yield. This is the average interest rate the BDC is charging its borrowers. Why it matters in 2026 fluctuating interest rate environment, this tells you how much earning power the BDC has. However, be careful. A very high yield, 15% plus, often means a BDC is lending to very risky, distressed companies. You want a yield that is high enough to cover the dividend, but not so high that it signals a desperate lending. Weighted average portfolio yield. Okay, so high yields it might be a danger sign. Number five, debt to equity ratio, which is their leverage, right? BDCs borrow money to lend more money. By law, they are generally capped at 2 times debt to equity ratio, though most target much lower than that. Why it matters. It tells you how much room the BDC has to grow. If a BDC is at 1.5 times or higher, they might be tapped out, so they don't have much room to grow or make new loans as a result. The target you want to look at, the most conservative, high quality BDCs operate in the 1 to 1.25 range. So that's where you want to be. So summary on the BDC checklist I have is NAV per share. I want to see it stable or growing. It doesn't matter if it's at a premium, because a lot of times being at a premium to the NAV, if the share price is higher than the NAV, that means they're actually growing as a company and they're getting a high valuation from investors. Whereas if they have a declining share price to what the NAV is, it's not necessarily meaning you're getting a discount at times. It might mean you got a declining interest from investors, and that's why you see underperformance. NII cut, net investment income coverage. You want it greater than 100%, basically earnings to what they pay out in dividends. So you want them to be able to cover that by over 100%. Anything that's under 90%, that's a danger sign because they're paying out more in the way in dividends than what they're earning. So NII coverage, you want that greater than 100%. Non-accruals, basically defaulted loans, you want that less than 2%. And definitely not greater than 5%. I say even if you get over 2%, that's a danger sign. Price to NAV. So you want basically 95 times to 1.110 times NAV, basically a premium to NAV. Either trading in close to NAV or a premium to NAV. Anything that trades at a discount to NAV could be a potential warning sign that investors are fearful and they don't want to buy in, so they're not running the share price up because they're avoiding buying. And so you're seeing a discount because the share price is dropping because there's no buying pressure. Leverage 0.9 to 1.2 as previously discussed, and no greater than 1.6. So you don't want to be over leveraged too. I'm going to look at that again. The debt to equity ratio leverage, that's what it's talking about. So you don't want that to be in excess of 1.5. You want to be in a range of 1 to 1.25 max on leverage. All right, so look at these valuations that I use. I'm going to look at Main Capital and see how they stack up. So here's a summary of our BDC checklist: NAV per share, NII coverage, non-accruals, price to NAV, and leverage. And let's see how we stack up here with Main Capital. So with Main Capital, their NAV growth is at 1.8%. So they're trading at a high premium, which is a sign of strength. Investors don't mind the premium that it's trading at because they know it's a strong company, and that's why it's trading at such a high premium. Dividend coverage, 130% coverage. So basically, they're paying out. They got a surplus. Basically, they're 130% over what they make in earnings, and so they're way above what they're paying out. So that means they actually pay out surplus dividends on a quarterly basis at times too. So you'll get your regular dividend plus a surplus dividend, a special dividend occasionally. Non-accruals are currently at 1%. That's excellent. The price to NAV trading at 1.78 times. So yeah, trading at a premium. So the net asset value is growing over time. That's 1.8% and is a record high. The price is trading at a premium to NAV. That's a sign of strength. Investors are buying and don't mind buying at a premium. Debt load 0.73, so it's under these metrics that we were talking about of 0.9 to 1.2. This is why I like Main Capital, and I'm thinking about trading and willing it. And if we look at Main Capital, just pull up stock analysis, and we just could type in look at their overview. And we get to look at their performance on price on a max time frame. On a max time frame, they're up over 304%. On the 5-year time frame, they're up over 72%. And this is the share price. That's all this is. This ain't counting dividends. And on a 1-year time frame, they're starting to come down a little bit, 1.62%. BDCs are fearful. There's a little fear among investors regarding business development companies because they loan out to a lot of them loan out to the tech sector, and lately the tech sector is going down a little bit, been selling off, especially software names. And so business development companies have been loaning money out to everything within tech, including software names. And so there's some fear wrapped around their exposure to software companies especially. So that's why you're seeing some fear currently, and you see a discount happen, not a discount in NAV, but a discount happening with Main Capital. Now it's fallen down from its highs where it was above $64 a share. Now it's down over 10.83% in the last 6 months. So I'm getting ready to will it because it's trading discounted from its all-time high at this point. And we look at the dividends on it because of the special dividends. It's being quoted at 7.2%, and they pay monthly. They have monthly distributions on that. So over 7% yield distributions on a monthly basis and a growing dividend over time. So it's been pretty consistent for the most part. And you see that dividend has actually grown over time if we could just track all the way back in time. That's why I'm going to will Main. And it's optional too. You could do options on it. Give you an example. That's Probe Webull. It's the quickest thing I could access without having to sign in an account. And pull up Main, go to the options table. And what I mean by this is where I want to get assigned at a cheaper cost basis. Let's put up 20 March, I'm a little over 30 days out. If I was to sell a put at the money, current share price around 59.44, at the money strike would be 59.40, right? If I was to sell a put currently, the price is going between 1.9 to 2.25. The last contract was filled at 2.19. You multiply that by 100 shares, that's $219. That's how much money I could receive in premium if I sell a cash secured put with an expiration in 20 March of 2026. So just a little month away. So it's lucrative, and you can see the open interest is at over 1,136 on open interest and 197 for the daily volume in options exercise at that strike price. So it's very liquid to trade options on Main, and Main's a stellar company and has a significant dividend yield, and it pays a monthly distribution. So why not do options on it? So if I get assigned, I lower my cost base. If I receive $219, I lower my cost base down to $57.20 basically, right, per share for 100 shares. And then I could always average down if needed. If I get in prematurely and the price gets a deeper discount in the future, I would just average down, because honestly, Main's a pretty stellar company. It's done really well in its time frame. You could look at the institutional investment. A lot of people are selling currently. That's a warning sign. It's given a hold rating. The minimum analyst price target is at 57. The max is 74. So we're in that range pretty much. We could look at it overall on different metrics, like how it's performed over time and stuff too. Just look at a chart, pull out, get rid of the moving averages. Do that, and we can just pull out a monthly even. You can see that price action. This is just old price action. So it's currently starting to dip, starting to round off at the top there a little bit. We're getting a discount on it, and that's liable to ramp up more than likely if the market dumps and the tech sector continues to dump, and software names put fear into the business development company sector. And so you'll see a further discount, I would expect. So right now, I've got an option at that strike, and I'm watching it because I think I could get more premium in the future. And I'm looking at maybe even a 56 to 57 strike before I get in. I want to be at a previous support level. And so right here, that coincides with about 57 something a share. So we're currently at 59. So if I pick a strike on Main, I'm probably going to start with a 57 strike. And so we could look at what that would pay if we went out to March 20th. So a 57 strike, which they don't have, but they have a 54.4 strike, and that's paying 65 to 80. So the last fill on that was 79, basically $79. So that's probably the strike I would go with. And you see the open interest is massive at that strike too. So you're going to get a fill somewhere in that range between 65 and 80. So come around Tuesday, if the share price is down another day, I'm going to sell the put at that strike. All right, guys, this ain't financial advice. This is how I'm looking at the business development companies out there. That particular sector is getting hit hard lately. I have a whole watch list devoted to basically quarterly will swing type stock names, and most of these are all business development companies. I do have a PBR in there, an XLF, which I'm currently willing to, and I have Rhythm Capital on there, which I think I don't know if it's a REIT. I think it's business development. But anyway, you can see they've been declining. They got hit really bad last week. HTGC got hit pretty bad most of all. I think they did a share dilution, and they missed slightly on earnings. But overall, these are all stellar companies normally. But there's fear around lowering of interest rates. If the Fed lowers rates, how it's going to affect their floating rate structure, in addition to the fact that the software names that have been selling off are pretty fear into some of these names too. All right, guys, be careful out there. Not financial advice, but I'm currently willing this entire sector by selling cash secure puts on it. All right, take care.